What's up, everybody? Welcome back to the Real Estate Reserve Podcast. I'm Jason Balin at Hard Money Bankers, co-host Ian Horowitz at Equity Warehouse, coming to you live from Columbia and North Wales, Pennsylvania. Welcome. No guest today for the show, but we still got lots of other stuff to discuss. We're actually going to do a live look-in on a $5 million acquisition of a deal that Ian and his partner Dan through D&I Development are working on. Throughout this episode, we've got lots of things we're going to share. I'm going to share my screen here in a second. Definitely excited. It's a property in Southampton, Pennsylvania that Ian and Dan have been working on here for a while. And we felt, hey, why not just share this with our entire community? All of our followers and our audience that we certainly appreciate. And just, I don't know much about this project yet, so I'm excited to kind of pick Ian's brain live, kind of show everybody what I'm interested in as a potential limited partner if he's still, looking to raise additional capital for. And I think we'll all kind of get a lot of insight by just sharing this actual live, real life deal. So Ian, what's up today?
What's up? There's a lot going on. I mean, I think we should probably bail on this and talk about how rates are coming down. But then again, I have no clue how it affects me, so it doesn't matter. So let's just continue to do deals. Many of you guys know, those that are over at CRE-syndicate.com know that we are doing the $50 million challenge, and this is one of the properties inside the $50 million challenge. So I'm super excited to kind of walk everybody through. This is kind of what happens with Jason and I in real time when we're discussing, deals and raising capital. I do a bunch of stuff on my end with Dan, and then it's like, okay, it's time to go to the market. Let's talk about some capital. Let's talk about some deals. And it's just good to know what, other people in business are doing. Jason tells me about fun loans. I tell him about fun deals. Sometimes we connect, sometimes we don't. So let's go through this sweet deal, and I'm going to follow Jason's lead, and we'll go from there.
Yeah. All right, so I'm going to share my screen real quick. If you are watching this live and not on audio only, you'll be able to kind of see what's going on in particular on this deal. Again, I don't even know much about this deal, so I'm excited to kind of dig in, and I'm going to be digging in with everybody who's watching and listening on this to see what's up. So let's see, brochure, PowerPoint, where are we starting in?
Yeah, why don't you go? Let's just go to the brochure and kind of talk about like how the deal came about, because I know a lot of the times you like knowing that. So here's the deal. You guys can see the address in full transparency. We do have it under contract. Our deposit has gone hard. We're working with our lender, but long story short, there was a tenant in this property that had brought us this deal. They wanted a partner, and we couldn't figure out a good way to structure it. They were a little gun shy. And the more I kept looking at this property, I was like, dude, I really want this property. So finally it got to the point after about a year of talking about this. I called the broker. I said, screw it. If the tenant doesn't want to do anything, let's call the seller, see if we'll sell it to us. Now, the seller is notoriously business savvy is the nicest way to say it. Is just notoriously like a hard negotiator. So we approached them, and I don't know if the stars aligned, my last name was right, whatever it may be. He decided to negotiate with us, honor his word, exactly what he said he would sell it to the tenant for. And here we are today looking at a 55,000 square foot flex space, more of an office conversion back to flex, which is super exciting. So that's kind of how the deal came about.
Yeah. So let's go through what this is that we're looking at. I'm just going to scroll through this so everyone who's watching can be entertained, including myself, to see what the property is all about. But how many units is this? How many square feet is this? And what's it kind of currently set up as?
Yeah, so there's 55,000 square feet. It's located just outside of Philadelphia. It's being broken down into 11 condo units. Currently, there's 3 tenants there that are occupying the property. And there is, I'd say, out of that 55,000 square feet, about 30,000 is occupied, and the other 25,000 needs to be renovated, which we'll go through some pictures. Needs to be renovated and brought back to life into more of a. It used to be Countrywide Mortgages. Call center at one point in its life. That was like the last known big use to it. That's why you see all the office cubicles. And then the seller had started bringing some of it back more into a retail / flex space, like, warehouse, like mini warehouse. You got an office with some warehouse type space. So all these cubicles still exist. You guys will see them in the pictures. It literally looks like Countrywide picked up and moved out. They used to have almost 400 employees that went there every day. So
at least I know where to go to get updated office furniture that I need.
Yeah, well, you want a big mortgage company? There it is. Come over, come get it.
Dude, you got tens of thousands of dollars. You probably got $100,000 worth of furniture right here that you can sell.
Yeah, I might go raid some new office chairs because those things, I hate buying them. Might have to put some of them warehoused up, ready to go. I know a bunch of firehouses would enjoy them, and maybe we could donate some of that and get some tax credit on our side.
I like that. So, okay, just so everyone's clear, including myself, is this currently 11 units already? Is it broken up as 11 units already? And you mentioned something related to be condotized. So I'm guessing when you're using that term that it's going to essence be 11 tax records, right? It's going to be 11 deeds. It's going to be 11 potential individual owners. Now, those owners can be obviously the same people, but it's going to be 11 individual properties. And is there, and I think you mentioned the condo project's already done. It's already been condotized. Is it already in the configuration of the units?
Yeah, I think if you went to Google Maps and pulled up this address, 95 James Way in Southampton, that would help everybody get an overview of how we ended up in this condo situation. And the reason we ended up.
Go ahead. I'm going to bring that up in a second.
The reason we ended up in this condo situation, so it's going to be broken down into 11 units, which you'll be able to see in the overhead. But the seller didn't want to go through a subdivision process. And, that's a very long, lengthy process that, you got to wait for the towns. However, in a condo association, you can do this almost immediately. So if you view an overhead, if you go up top.
Sorry. I'll do that.
Zoom all the way out. And let's do an overhead. And you'll see that this property is actually adjoined with another building. Scroll out just a little. See that big building on the corner? Yep, that building there. So that building and this U-shaped building are all on one tax parcel. We're buying the U-shaped building. Nope. We're buying the U-shaped building where the red dot is, and the building to the left.
Oh, I see. Yeah, correct.
Yeah, and the building to the left are on one tax parcel.
1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11. There you go.
Yeah, exactly. So you can see each kind of like firewall bump out where they're offset. That's how we're going to break it down. That's how the condo association was being delivered. We normally wouldn't look at this and say, well, let's go sell off some units. But since it's being delivered in a condo association, it's giving us a secondary exit strategy that we're not necessarily planning for. And actually yesterday when we were walking the property, we had another tenant close by that the brokers had known came by and said, hey, man, I'd be interested in buying a condo unit. You don't ever see these come up for sale, and I'd be willing to pay top dollar for that. So it's an interesting secondary exit strategy that this type of property space allows you to execute on. So we're excited to see where that piece of it goes.
What's the benefit of doing this as a condo compared to just, because I think that's a unique situation, right? One owner. Yeah. What's the benefit of doing it this way, or did you have to do it this way?
No. So kind of. The benefit is the seller can sell this piece of property off, and then he's still got his parcel to the left, and we don't have to go through the subdivision process, go through zoning and planning and all these other things.
I see.
You can create a condo association as long as it stays within the conforming rights, and you can go and record that the next day. So I said, hey, we're interested. He said, cool, I'll record the condo association tomorrow. I already have all the surveys and it's done. And we'll see that here in a second.
So in essence, your purchase is going to be comprised of 11 individual properties. And these are the 11 individual properties that make up one thing.
Okay. One building. Yep.
This is similar to that that church deal I was telling you about. That's inside another big property, and it was condotized into certain little areas. So I like that. Okay, that makes sense. I mean, I like the idea of having it as condos, right? Because then you can either own them and rent them all out individually. You sell them off, one by one. You have more options, right? It's very, instead of selling an entire building off for whatever $10 million down the road, you can sell each unit off for $1 million or however it is.
Yeah,
cool. I get that. That makes sense. Looking at these pictures is really helpful. So, is all 11 of these office at this point?
No. And if you kind of go through the picture back to the overhead, 2 of the tenants are still office space. One of the tenants does some very large scale printing for a lot of like the airport, local transit companies. They do gigantic stuff for the Franklin Institute. Just right really great. Yes, just really big, gigantic stuff. So theirs is set up more as an office warehouse combination, whereas all the other 2 that are existing tenants are set up as office spaces. Our goal would be to set the units up more into a office warehouse type situation, because once we zoom in a little bit and we start looking at this property, you're going to see that it's actually lends very well to small warehousing, which we're excited for. So
when you say small warehousing, like there's going to be garages and then there's going to be office in the front and warehouse in the back?
Correct.
Got it. So like flex space. Okay.
Yeah.
Cool. I mean, that makes sense. I understand this. Let's go through. You want to go through the PowerPoint? Well, is there anything? Oh, well, here's some other pictures that I think are helpful to see. What is this?
Yeah. Are you going to be able to scroll through, or you got to go back and forth each time?
I can scroll through. God. I mean, that's good. Hey, there's a desk right there for you. And, chair for you. That's a good one. Bring some down this way. Let me just find some cool pictures to go through instead of going.
Go down a little bit. You'll see. Keep going. Where are they? Go back up. Yeah. So there you go.
So this is the flex component, or this is
go back one picture to 50. This kind of gives you a good overview. You can see these glass windows where they are. We'll be able to take them out and put garage doors in there. And this would actually almost be 2 condo units. You can't really see the vast size. I think there's another picture in here somewhere that'll show you how big this is. It's almost 10,000 square feet that we can break down into 2 5,000 square foot units. And then we could sell them off or we could lease them. And then where those big windows are used to be garage doors. We're going to put the garage doors back in there. We're going to set this unit up. And it's basically like, this is what we have. This is what you're going to buy type deal. And that's it. So
when you say put these into smaller units, does that mean take this from 11 to additional units?
No.
Okay.
So right now, like right where your cursor is, that's the unit we're looking at. And it basically goes from the corner of the building down to where your cursor was, comprises that 11,000 square feet, right? So what I'm saying is, well, right now it's wide open. So if someone came in and said, hey, we want 10, 11,000 square feet. We got 2 units for you. Or someone comes in and says, hey, I want to buy a 5,000 square foot unit. What can you deliver? We could put the demising wall in there, deliver it to them, sell it, lease it, or do anything in between. Our goal would be to go in there, clean it up, do 1 show unit, show exactly everybody what we're going to do, and then go through and renovate the rest. And really just have a basically like a sales unit almost to be able to show people exactly what they're going to get.
Got it. All right. So I know, and again, I briefly know a lot of these things, but we've talked somewhat basics in the past, basics. So, and you said 3 of these are rented. I'm guessing these ones that have Google, Google account or Google business accounts, or it's probably these 3 that I'm guessing.
Yeah.
So how much rent is already coming in?
Don't quote me. I want to say it's roughly $35,000 to $40,000 a month. on triple net leases, so there's not much operating expense, which is fun. So there's good initial operating income right away.
Go ahead. I'm listening.
Yeah, you can, yes. So I mean, I'm just kind of going from memory, but yeah, about
Oh, that's
40,000.
on here. Got it.
Yeah, it should be in there
Probably.
somewhere.
I mean, and the reason why is I'm asking is, when you're buying a property that's number one value add, it's great because you can, as you're adding value, it's increasing significant in value, and you're making, potentially on the back end very good, equity pops. But when there's income that comes in day one, and if it can, I don't know if is it going to support, you think, everything up front?
I know it definitely supports the debt. It definitely supports the debt. It'll be close on the preferred equity, but it's something that we're going to budget for because again, we expect somewhat of a quick lease up because what's different about this project that we've never done. I don't want to say we've never done, but like this is like core product, dude. Like this is we're in like super great market. We're super close to Philadelphia. We're outside of Philadelphia for all the crap earned income and home rule type taxes. A lot of businesses are in this little juncture, and like this is beautiful infill product. So we're somewhat bullish on the input side of things. And that's our expectation on this. So it's well, I know there might be a shortage in the pref up front. I do think long term and a very short near term, shall I say, that the thing will fill up.
Got it.
To be able to support.
Yeah. And I mean, that is the last page. I didn't want to like fly through some of these pages. I was trying to just look at some important stuff to make sense. So in essence, you're already going to get a loan. I'm guessing you're getting a loan from your current, the lender. Current company.
Yeah.
The current lender that you've done a lot of other stuff with. So that shouldn't be a problem. And what are they just doing it? They just do it based off that 5.5 purchase price. What's that?
5.5 purchase price with coverage against the existing income. So that loan amount is going to be somewhere we believe 3.9. However, as markets are changing in real time as we're doing this video, hopefully they stay at 3.9 and don't lower. But we're going to find out. Actually, he called me while we were on this, so I'll find out about that. But we expect that to be somewhere between 3.5, 3.9. The interesting thing is, with debt being so high, north of 6%, your debt and your equity costs are almost similar. You just need to make sure that you're the more equity you bring in, you're not liquid, you're not watering down your other capital investors. So if that loan swings by $500,000, what does it do to the rest of the investment? So, and I know a lot of people, I don't know how many people know about this, but a sources and uses, this is really important for your lender. I started setting these up front so they can see it. But then I found out investors like to know where their money's going. We're buying it for 5.5. Closing cost is $225. Legal fees going to be, I just budgeted 50. Construction budget's going to be roughly $1 million. Soft costs, your architectures, holding costs, surveys, all your due diligence items. We expect to be about $150,000. Working capital, we want to have about 2 months of operating expenses on hand, not including debt and equity requirements. So that's another $100,000 of cash that we need to bring to the table, whether it's us, a capital investor, whoever. This is how we like to set this up, make sure everything balances out. We know where our money's coming from. We know where it's getting spent, and then we can move forward and continue on. So.
Got it. Yeah, it makes sense. Got it. So 3.9 on 5.5, so about 70 LTV they're going to lend you, and then you're raised to cover the difference between the difference that you need would be about $3 million that you're going to raise from capital investors.
Yeah, I'll raise that. We'll move that up to like 3.1 or 3.2 to give us some buffer. I like doing the exact numbers here, but when it comes to raising capital, I don't like doing oddball numbers. I like doing everything by multiple of 25s.
Yeah, no, I get it. What is approximate interest rate from the bank?
6.5. I got to pull up the term sheet.
And what do they do? 20? Is that like a 20-year ammo with a 5-year?
No, 25-year ammo. And 25-year ammo with, I can pick my rate locks 3, 5, or 10. You could pick a 7, but why would you? I think right now with the way the markets are moving, I'd probably bet on a 3-year to be lower than the current 6.5 rate or whatever we're at. I think if it got closer to 6, like 5-ish, like high 5s, I would debate about locking out for 5 years or 10 years if it covered, because one learning lesson that we've from like our other projects is, things are going good, but you don't know what's happening 3 years from now. And rate resets can not fuck you in the sense of like, they're going to take your property, but rate resets can change your cash flows and your availability of cash to pay for certain things. Right. Like, so with that being said, we've kind of talked about it and said, when it makes sense, we'll take short term. I think we're going to end up in somewhat of a falling market here for a little bit. So I'm probably going to bet the 3-year. But if it was sub 6, I would legitimately debate about taking 10-year money, just to, especially if it's something we want to own long term and protect. So it's interesting conversations.
So what's the difference in rates? Do you know? I mean, obviously the prepay is a big deal, right? And
but they're all the rates. Sorry, I'm going to cut you off. The rates are all the same right now, right?
Got it. Because the rates are the same. It's just the prepayment penalty.
Yeah, because of the inversion, longer term money is technically a touch cheaper, but there's really no delta. You got to remember when we're talking in the heyday, which was a few years ago, right? Like that's, everyone's getting money super cheap. You're getting 3% money on 3 years and you're paying almost 5% on 10 years. Well, if you would have bought 10-year money and paid the 5%, you would have looked like a genius then, right?
So God, I've been thinking this is an interesting setup because based that it's condotized and you can sell individual things, because there's an argument of, what do you say? Keep going. So there's an argument of like, hey, you sell one, you get $1 million, but you don't pay off your note. You pay off the capital investors, right?
Yeah.
On that particular situation, because let's be honest, your pref's more, however you have to work out with your capital investors, the pref's more expensive than the debt.
Well, especially amortizing debt, right? Because usually I add about 2% on top of whatever the rate is. So if you're paying 6% amortizing, that's technically 8% money. Your 8% money is the same as pref for equity. The big difference is you are buying down principal, which technically makes your investment safer and safer and safer. And if you want to go up one page, I think you just showed it, the exits, which I know we're kind of.
Yeah. Are the prepays on something like this, like a waterfall prepay? So like if it's 5 years, you got a 5, 4, 3, 2, 1, or how does that set up?
Yield maintenance. So
they want to make a certain return.
So if rates fall, you're going to pay. If rates increase, you're not going to pay because they can lend the money now out at a better rate, right? But if they fall, say you're paying 6% and they go down to 4% and you got 3 years left, you're paying that 2% delta for that 3-year time period of a guaranteed return. However, if you've created that much equity, most people would say, who gives a shit, right? But again, it's all hypothetical. I think a lot of people forget when they're doing underwriting and looking at these deals, oh, that'll work. Don't worry about this. I'll do this, this, and this. Everybody got a plan until you get punched in the face, right? So again, just got to navigate and work through these things.
I think this is an intriguing deal because you can sell off. I know preliminarily we were talking and you're like, well, I could sell off some of these units to break even, have this thing free and clear, and then own, whatever, half of them or 40% of them still, and they're all free and clear. But like, I didn't even think about that. Like, you could also, again, sell 1 or 2 of them, pay your capital stack back if like it happens quickly, right? You could pay your investors back. Like you could pay off the first position, but if you have those, if you have good debt and you have long-term prepayments that you're concerned about, it's like, okay, well, I don't have to pay off the lender, but I can pay off the capital investors, and then at least there's not a preferred equity going out the door.
Well, and here's the other thing. Like, I know we talk about a lot, and you're big on, well, just get your money back, lock your profits in. Who gives a shit? Pay your taxes. And for a long time, we've always been hold. Well, we're getting ready to sell one of our apartment buildings that we're going to make a bunch of money on. It's like, wow, what a windfall, right? So it's like, your IRR technically is higher if you made less money, but you got your money back quicker. And like we're not IRR metric based, but in technically speaking, and in reality, if instead of making what's this say? If we held it for 5 years, I'd make 3.1 million bucks on a 7 cap, right? Or what if I went in and I could sell all my condos at $1.60 a foot in 12 months and get back 1.8 in 12 months? Which one's better? I still don't know because we're not like huge sellers to the market. But in the same sense, the more we look at it, the more it's like, well, shit, like, well, maybe we sell off half of them and keep the other half free and clear of debt. Or maybe we sell them all off and we pick up 2.3 million in an 18-month time frame. Well, that's a win too, right? So we've been having a lot of interesting conversations around that. We've told the brokers we're not dead set on any one business plan. We're open to all and every idea, and let's just execute it. When I underwrote the lease to sale in 5 years because that's the standard metric that we can go off of. But I believe we'll do pretty well in the sales standpoint on execution, and have been having really good conversations around that.
So let me go back real quick just so we can see this. So 6.9 is your basis, obviously, with everything. Yeah, and then kind of on the low end, about a $2 million swing.
Yeah.
On the high end, a good bit more, 2 million more.
But here's the bet, right? Like if rates just fell a little bit today, well, the treasuries start to come down and debt rates start to hover in the 5 or 6 caps. This is technically a really B plus asset that we could probably chase down a 6.5 cap rate if debt fell. Keywords if, right? So I got to assume that we're going to sell this in the 7 to 7.5 range. So then what does that tell me? Well, it's 7 and 7.5. My range is 2.4 to 3. Okay. Well, if I gave up a little bit of money and sold from like 165 to say 180 or 190, because there's not a lot of this product in there, and I would say 165 to like 180 is realistic, and I could do it in a shorter time frame. Well, wouldn't it make sense to just take the bird in the hand and not risk for another $1 million bucks? So it's again, this is the mental mind fuck that everybody goes through, and this again, that's why I like this condo association. That's why I like the way this one's set up. We have multiple exit strategies because we could sell and retain, and I think that's cool too.
No doubt. Real quick, let's go through one other thing. So obviously closing costs, legal, soft costs. What type of soft costs do you have on there?
Architectural. You got architectural, you got due diligence fees such as like appraisal cost. Like we had to send a $50,000 deposit to the lender. That'll get busted up with their legal fees, their due diligence, their property condition reports, their all that crap. Sure. We got to pay an architect, which we'll see some plans here to come in and do all that design. That's like a lot of your soft cost working money to get the project set up, any permits, all that fun stuff.
So let's just go through kind of broad construction costs, just so everyone watching, including myself, can understand that side of it. Like what type of, so I'm guessing these people already have leases, right? So they're staying in place. Yeah. Your construction costs aren't necessarily TI, tenant improvements for new tenants coming in, right? This is, or does it include that? Or is there actual like capital improvements, roofs, garages, windows, and stuff like that have to be done? And interior, like, are you building out these interior units first?
Yes.
Before tenant comes in? Talk about.
So the first thing we got to do is we got to get the roof squared away. Everybody can see the roof. Oh, I don't know what you just did there. Now we can see the whole country. Look, the Earth's flat. You can see those roofs are destroyed. That's pretty accurate. We were out there walking that yesterday. The roof's destroyed. Some of the rooftop AC units are not working. We need to get them squared away. If you zoomed in on a street view, you would see that the landscaping needs to be straightened out. The outside of the building needs to be presentable. The parking lot is in deplorable condition, right? a lot of these things are going to cost. Oh, you're on the turnpike. You went on the turnpike. Just go out to James Way. A lot of these things need to be updated as a part of our construction cost. So our budget moved from when that original PowerPoint presentation was presented. I had put in there about $20 a foot. That's right around where we are now. Less money obviously gets spent in the currently occupied units, but you can see this landscaping is all jacked up. The building needs to be painted. The drive-it or the stucco needs to be cleaned up, pressure washed. Landscaping needs to be hacked back. It's pretty accurate pictures. So those are all things we need to do. Now in the vacant units, we need to go in there. We need to get all the office furniture out of there. We need to get all the we need to get everything squared away, which you'll see go down. Yeah, so there's like an old telecom, an old data server room that we need to get cleaned out, right? Like that's one of the tenants. Keep going down. Like here you go. Here's a unit. Yeah. So there you go. We got to get all the grid out. We got to move all the lighting up.
You got a drum set that comes with this too?
What's that? No, it's the one. The one tenant's got stuff in there.
So this wasn't like water damage though, right? This is just, or is there actual like damage from that type of stuff?
No, so the guy just started taking stuff apart. I don't know. He had a roof leak at one point, kind of ghetto fixed it. But all that drop ceiling's coming out, all the lighting's coming out, everything's getting pushed up to the deck height that's 14 foot. You know what I mean? We gotta get all the carpet out there. We gotta get these floors cleaned. Keep going down. That's printed ink. So here's a good example, real quick. Don't go anywhere. That's the one tenant. And you can see how clean their facility is. This is something similar that we would deliver. The only difference is I'm going to get rid of all the drop ceiling and pick the ceiling height all the way up for people that need racking. But you can see how clean this site is. There's nothing on the floor. They're ready to go. So you can.
So how high? How much higher can you go? You can. What is how high?
They're probably 10 foot. There's probably another 4 foot up there.
There's 4 feet that you can go before you hit utilities.
Yeah, which you might not think's a big deal for your business, but someone that needs to store stuff, it's a huge deal.
That's a big for somebody who needs a golf simulator in their office.
Yeah, absolutely.
Like Keep me, because that's our issue right now, and I don't think we can go up any higher.
Hit 94.
Hit 94.
Love, yeah. So here's a vacant unit, right? We got to go in. We got to clean all this out. We got to get the garage doors in. We're going to spend inside the units probably $10 to $12 $10 to $15 a foot. On the exterior, we're going to spend anywhere from $10 to $15 a foot, just as like a real generalization. Now, one thing we were discussing is we're going to go in there. We're going to set up the office. We're going to set up the warehouse space, and that's what we're delivering. Somebody wants to buy a unit specialized. Here's the base unit price. Here's the build-out cost to do it. You want to lease it? Here's the base unit. You can go build it out yourself, or you can pay us to build it out. Other than that, this is what's being delivered. A lot of this tenant and owner type is now money. Oh, accountant says I need to buy something by the end of the year. I got to go rent a space tomorrow because our business, we just doubled the size of our business. I got a shipment coming in, right? Like this is very ready, very now type tenants.
Yeah, no, I got it. That makes sense. And what do you think your average cost per square foot is going to be for renting? It's the sale would be about 170 a foot. I saw.
Yeah, we'll get about $14 a foot triple net rent. So it's pretty good. $14 a foot. I think I'm gonna put a foot in my mouth, but there's comps anywhere from 12 to basically like $18 a foot. If we make sure the warehouse is conditioned and the rooftop units work, I mean, I think we can get upwards of almost $20 a foot. So it's super exciting.
Nice. Just going to see if there's any other pictures that go out.
There's a good.
Let's answer Mitch's question real quick. Says, looks solid. How certain are you on the condo route?
I mean, we're going to let the market kind of dictate where it's going. We're going to approach our current tenants and just say, hey, here's an optionality before we go this route. We want to make sure you guys, if you're looking to expand or you want to buy or you want to lease anymore, here's what we're doing. And if they say yes or no, then we'll just take it to the market and stick it up for sale or for a lease. A business friend of mine ended up in a situation where he condoed off a bunch of units and then lost control of his condo association, but then still owns a few units inside the building that he built. And he said it's been absolutely miserable for him. So I think if we go the condo route, we want to know that we can sell a vast majority of it and just say, okay, we own these free and clear. We don't really care what happens with the condo association, or we know we can sell every single unit. Let's get out. Let's make our money and keep it moving.
I mean, here's the thing, so you mentioned earlier that the guy condotized this other building, which means that he's obviously still going to be a part of the condo association.
Yeah.
And I'm guessing, and I don't know this for a fact, but I'm guessing that he's probably set it up that he's going to have the most shares of the condo association.
Yep. Yeah. Oh, 100%. Yep.
Yeah. But either way, I mean, you guys are still involved in the condo association, and like, what are the risks of losing control of the condo association? Now, I know, I don't want to say I've experience with this, but like thought through some of this on projects I've been involved in the past. I've talked to attorneys about this, and like, to me, like, yeah, there's little things of like, oh, we don't want to use that vendor to cut the shrubs, or we want to vote on this paint, and then all of a sudden, like, next thing you know, the whole building's ugly. And like, one of the major things that, and you might know better than me, or if somebody watching or listening might know better than me, but one of the things that came to mind is like, hey, we want to use my brother's snow removal company, and it's going to cost us $200,000 a year in order for them to use that, and we're going to assess all the members. That being said, I've talked to attorneys about this in the past, and they're like, you can always, create, try to sue the condo association or whoever for like something that's just completely irrational, right? Like, for instance, if like the going rate's $5,000 a year and they get 8, whip-de-doo, but like, let's say they charge 100,000. I've talked to Harris about that in the past, and he was like, well, we could, you could file a lawsuit for, on that, because it's just irrational.
Yeah.
But I mean, but like, is there any other like real risks that, that you know of?
Yeah, to me, that's the biggest risk, because we don't really like owning condos. However, in the condo association, when we set it up, even though he has the majority of the control, from owning that building plus the 2 billboards, is we said, listen, man, like, this condo association is really just a shell entity to us. We're taking care of our own landscaping. We're taking care of our own snow plowing. And that is it. There is nothing else to it. Like, we're not getting involved. And again, that's the fear of starting to sell off condo units, because then we start to get watered down. But you know what? It's the game you got to play. I'd rather have a few bucks in my hand and deal with some of the headaches. And, in the end, the condo fee is going to be a pass through the tenant. The only problem is it won't be affordable for tenants. So that's one inherent risk that you need to navigate and watch. So with that being said, it's I think that's an inherent risk there, because we are not in control. However,
but here's the thing: you're not going to be in control with 11 of them or with 4 of them. So why not sell them anyways? Like,
exactly. Yep.
Like, I mean, what attracts me to this deal in general is that you can sell off parts of it, which you can't really do in a clean fashion in a lot of other projects that you've been involved in. And it's like, hey, we were going to plan to hold these things, but someone offered us $1 million, which, for one of these units, and let's say they're all equal units and all of value, and that's $11 million valuation. Right now. And is there a play to sell units to the current tenants?
There's brief discussions technically inside our contract. We cannot, it's kind of weird. We can't really approach them, but we need to do our due diligence. So we've had very brief conversations, but I think there's a potential that 2 of the 3 end up buying. But again, we won't know until we enter into it and start moving. It's also really hard to come in and buy it and say, hey, come buy it, and we don't make any capital improvements, right? Like, I'd rather say, hey, we'd be interested in doing that, but we need to do a bunch of work to this site, so we're not set up in a bad position. We want to do the landscaping. We want to get the parking lot squared away. We want to get everything set up for you so it's ready to rock and roll. Then we'll have a discussion. I'm still willing to give them a discount off the rate because they're existing tenants, but I don't want to go and say, hey, we'll sell you a condo. Say we're buying this thing for $100 a foot, and they're like, well, we want to pay you $110 a foot, but we still got to put $20-$30 a foot in there. So yeah, we had some architecturals done just to confirm square footage to see what the delta is. There's about a 2,000 square foot delta. Some of she measured interiors, not exterior walls. Technically, to the exteriors, it's probably 55,000 square feet. So there is a little bit of delta there, but we just wanted to confirm. We wanted to see how the current leases lay out to, if you go down one more, how the current leases lay out to the condos. So the colored straight up and down vertical lines, the purple, the green, the blue, the yellow, and the red are the condo units. The blue starting in the top right corner is a tenant. You can see they cross condo lines. That whole next yellow block is a tenant. They cross condo lines. So like that's going to be a hard condo sale unless one of them wants to buy the whole thing. So that's a discussion. And then same thing with the brown one down bottom. The brown one has a bump into the green on the right. So we would need to do an easement carve out or figure out how to move those bathrooms.
Where's the bump out on the brown one?
Right. Go to the right, just past the red line.
Oh, just this?
Their bathrooms bump into the next unit. Yeah. So we need to figure out how to move them, or we need to do a easement inside the condo unit to then say, hey, this is technically their bathroom easement, blah, 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 and everything else. So with that being said, it's not a big deal, but we wanted to see how the leases laid against the condo units. Because again, like Mitch is saying, hey, you want to go sell all the condo units? Cool. Yeah, I love the idea. But these leases don't even match to the condo association, which, again, makes it tough.
Yeah. Well, this one's conforming. This one's most of them are conforming though, right?
No.
I mean, all the vacant ones.
Yeah. So that green.
These two are vacant, right?
Yeah. And then left. Yep. That's vacant. Next one's vacant. And then that next piece is vacant, but it's shared with the part of that other yellow lease.
I mean, yeah.
I have a plan.
Wait, is anyone in this brown one right now?
Yeah, huh? a title company.
Yeah, and I guess there's no way to build. And then
there is. They would have to tell us they want to get rid of some office space. But honestly, by the time I spend the money to move the bathrooms, I'm just better off saying, hey, let's just cut an easement right into here, give these guys an extra 100 square feet or whatever that works out to, and take it off this one. In the end, we're still getting the dollars per foot on that square footage. It doesn't matter.
Yeah, I get it. Got it. Okay. Yeah, no, it's interesting. I don't know. The way I think it deals might be different than the way other people think it deals. As a lender who's investing like LP funds into a deal like this, I look at two things. What type of return can I get on our money short term? What type of kind of equity kicker to juice to a better return long run, and how quick can you get your money back? So to me, I look at it as like, cool, you got 3 tenants in place. Assuming they're all happy, assuming they have long-term leases, I don't know. I think they're mostly shorter-term leases, though, right? But like they don't have any. Just because their leases are expired doesn't necessarily mean that they're looking to move out. I mean, especially that printing company to move that probably 7 figures to get that printing company out of there. So there's no need for them to go. Part of me is like, cool, get these existing businesses in units into ready for tenant improvements or owner build out. And get those things sold and try to get almost all the capital recouped at that point. And then you have the cash flow from all the tenants, from the other half. I don't know. I mean, easier said than done. That's just the way that my brain works.
Yeah, I think that's what makes it fun is that there is multiple exit strategies on that versus like you said, a lot of our other properties don't. We started executing on some of our other properties of out parcels that we're not using, houses that came with some of the properties, car washes, vacant land that came with the properties. And it's like, well, we're never going to do anything with this. So like, if we can sell it, monetize it, and make a few extra bucks and reduce capital, like who cares? Like let's do it. So we've starting to talk in the flex space and condo space and all these other things. Like we've talked about this at Gaslight. We've talked about this at some other locations. It's really opened our eyes to say, man, if you can deliver small enough floor plates, people are very into owning a condo from a business standpoint because most businesses are small businesses. They don't like, I'm sure if you guys could buy a small warehouse or a small condo like you're in currently today, you guys would probably execute on that. Not a lot of people are following that along. So it's interesting, and it's fun to be able to help the small businesses to do it. So
Yeah, absolutely. Oh yeah, this guy's got like a triple unit.
yeah, yep. That's that big long yellow one that kind of bleeds over to the other one.
Yeah.
So
And here's a quick underwriting template.
yeah, which again, it's triple net leases. There's a bunch of recap, so again, initially there's a shortage on some of the pref. We know it's going to be delayed, but we also set this one up that the investors get weighted a little more in the with our normal equity split. Usually it's weighted towards us. This one we've weighted way closer to 50-50 because we know the returns need to be there to make it worth the time for the investors if there is a delay in some pref, so.
Yeah. Got it. Yeah, I'll look at all this myself too. Nice. Anyone who's watching live, we've had a lot of a lot of viewers throughout this episode. Obviously, certainly appreciate it. If anyone has any live questions for Ian, hop in real quick. Let's do it. If not, we'll get this thing wrapped up. Definitely seems like a pretty cool project. I'm excited to kind of dig in a little bit further on a few specifics and kind of see, if it makes sense as as an investor on this thing. But
and guys, just so you know, this is I don't want to call it a pitch, but usually when I call Jason, like, hey, I got a deal, or he's usually bugging me for a deal, I'm like, hey, I got a deal, what do you think? And we'll send it to him, and then I'll ask you, he'll go through it, and they'll be like, hey, can we jump on a video and record it, and let's go through a bunch of stuff. And this is what we just normally do in our day-to-day lives when we're putting together deals, at least on my end or Jason's end when he's putting capital into deals. So this is the real look, and this is what we're doing over in CRE-syndicate.com, just trying to show people what it takes every day to try to buy $50 million of real estate. I mean, you're just going through, I don't want to say you're going through the motions, but like, what is it? Block and tackle, right? Like you're doing your standard stuff every day. This is what we do every day. We're looking at deals every day. We're underwriting deals every day. We're re-pressure testing everything that we're looking at on every single day. So, this is a real life look at.
Well, this is also probably a deal that's passed through after 100 deals that you've probably looked at in the last few months. And I mean, it's not like this deal just came to fruition. Like this has been going on for a long time. I mean, I've heard this name for a while, and you're at the point now. It's like, okay, well, let's start getting this thing buttoned up. Let's try to fill the rest of our capital stack that ever needs to be raised. Finalize everything with the bank. Finalize some of our due diligence. So then, when this thing is ready to close, you have everything ready. When does a deal like this? Like, when did you originally contract this, and then, when's your estimate closing time frame?
Yeah, so my original conversations with the broker on this deal started in December of last year. I looked it up. We toured it in February. After we toured it in February, we kind of hemmed and hawed, didn't really do anything with it. Then finally in August, well, after going back, talking to the seller, a bunch of back and forth, it was the week of the White Marlin Open that we went into the contract because we were away, and we said we don't want our due diligence period to start. So the week after that, our due diligence period started, and I believe we're going to close it in November. So basically August, September, October, November. So we got about 4 months to put this whole deal together and get it to the closing table. So
nice. Cool.
Yeah,
cool.
man. I'm excited. It's fun. It's a really cool opportunity. It's aligned with our future business plan for 2020, the rest of 24, 25, and 26. It fits the metrics of being close to home. It fits the metrics of knowing the path of progress. It fits the metrics of literally everything that we want to do. It has a nice value add component that we can actively manage, and it fits our team and our model very well. So, I'm excited to execute on it and look forward to getting it all together. We're buttoning up the last of our details. And then we'll hit the ground running with, starting to raise some capital. I want to make sure all the bumps and bruises and all the hurdles of the lender is taken care of. And once we're in the right direction on that, then it's go time. So it's fun, and I'm excited to see this one close because I'm looking forward to continuing the case study and how this one turns out.
No doubt. Cool. I like it. That was a good episode. I'm glad we had a guest that had to reschedule this morning. So, we can always, we always try to do some of these podcasts with case studies. I think it's good for, I mean, they're my favorite types of stuff to listen to too, like real life deals that are going on inside the real estate industry. I think you get a lot of value of seeing what people in different parts of the country are doing, how they're finding their deals, how they're financing their deals, what cap rates they're going off of, how they're structuring their investor capital. I think that's very entertaining and good to know what's going on, because let's be honest, there's still lots of capital out there. There's still lots of deals out there. That's still good opportunity to sell, good opportunity to buy, no matter what's happening in this space. So again, thanks everyone for tuning in with us for the last 50 minutes. Much appreciated. We've got some really good guests lined up. We're actually booked all the way through December. We looked at today with weekly guests. So make sure you definitely tune back. And as we get some, other, real local real estate investors that are doing good deals, that's kind of our MO of what we do here. I think that's important. Any last words, Ian?
Nah, man, I'm excited to get this one going. I'm excited to see what happens. And please join us. If you guys get any value out of this, the best compliment you can give us is a share. We don't care about likes and subscribes. It's all about shares, getting the information out there, helping other people get involved in real estate in any which way, shape, or form. So,
and if you're listening to this on audio on iTunes or however you listen to your podcast, check out YouTube, because there was a lot of visuals and we did screen shares throughout this whole episode. So, not that you can't absorb this through audio, but get a little bit more context with YouTube. Thanks again, guys.
Thanks for tuning in to the Real Estate Reserve podcast. Do us a favor and like, comment, and share our broadcast. It helps the algorithm and helps us spread the word too. Till next time, thank you for tuning in.